I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong.
Hi, I'm JB. This video is a part of my series called Words of Wisdom, where I take some of the greatest of all times, use their great advice and their learnings so that we can get better ourselves. In this video, I'm going to focus on Benjamin Graham, the father of value investing, and his saying, in the short run, the market is a voting machine. In the long run, it's a weighing machine. And what does he mean by that? Well, he actually talks about the market being hyped, or should we say, voted. Like if a lot of people are chasing the same stocks, it usually leads to high demand and the prices rise. And that's actually what he means. There are two factors that determine the price of a company. One, demand and supply. Two, the fundamentals. In the short run, the demand and supply, that's what we call voting, determines the price. In the long run, the fundamentals or prospects, future prospects of the company, that's what we call the weight. Markets exhibit momentum in the near term, but revert to the mean over the long term. There's a lot of empirical evidence to support this, and it usually goes that way too. Who was Benjamin Graham? He's known as the godfather, the father of value investing. He was born in London, or originally his name was Grossbaum, but he changed his name when he went into Wall Street to fit in better. His parents moved to New York when he was about 1 year old. And when he grew up, he was a brilliant student, won a scholarship to Columbia University, and he graduated second in his class at age of 20. And afterwards, he was invited to teach at the school, but he actually refused. His father had died and his family was poor, and Graham needed a larger income to support the family. So he went to Wall Street and worked at a firm called Neuberger Henderson and Loeb for $12 a week. He actually started as a runner, delivering mail, securities, checks, wiring descriptions of bonds. Before long, he began to analyze companies, and at the age of 26, he was actually promoted to full partner. In 1923, he left to set up his own partnership, and in 1928, he began teaching investment classes back at Columbia. And over time, the lessons of his classes were gathered into the first book titled Security Analysis. This was published in 1934. That book has sold over 1 million copies, and Warren Buffett says he's read it at least 4 times. He was a student at Graham's around the 50s. Buffett always said that after his father, Benjamin Graham was the most important influence in his life. Buffett even wrote the foreword in the 6th edition. Benjamin Graham also wrote the book The Intelligent Investor, which is probably one of the best well-known investment books in the world. He also made another book called The Interpretation of Financial Statements, and this is also one of his great works. Well, this video is not supposed to be about Benjamin Graham, so let's get into the whole philosophy and idea of voting machine and weighing machine. What does it really mean? How can we use it? That's what I'm looking for when I research the greatest of all times and their teachings and what they have been doing, so I can become a better investor myself. And I gotta be honest, in this video, I'm gonna show you what I would call the dark side of this, because the way I'm using this is to get some short-term gains. That was actually not the intended use of it. Benjamin Graham used to say that the market behaves like a popularity contest in the short term. Stock prices change rapidly based on the environment, the hype, the people, what's going on, while the underlying value doesn't change. People chase fads, and there could be various ways a stock might be manipulated in the short term. And traders move in and out based on a number of factors that have nothing to do with the actual value of the company. But if you measure over a 10 or 20 year period, all the psychology gets subtracted and the price movement would mostly reflect the real value of the company. But market psychology is very hard to predict, and that's why you, as a value investor, should avoid getting into those short-term fads. So that's actually the idea of this. The market is a voting machine, and in the long run, it's a weighing machine. It means be careful of those hype stocks, those companies that get hyped and goes up and down just for a short-term period. And that's why I say that in this video, I'm going to focus on the wrong way, or how you see it, not the intended way, to use the saying. I mean, I'm actually counting on that the market is a voting machine in the short run. So whatever is hyped, I kind of trade it as a short-term trade. And please be aware that I'm only using a very small percentage of my account. I'm not going all in on some kind of stupid hype stock. I have my core holdings, and those don't change. And I have some growth that I'm chasing. But, people easily get bored. And as a long-term investor with just buy and hold, I need something to play around with. And that's where this comes in. I find those hype stocks and use the voting idea that everybody is running after the different stocks. This pumps them up, and I buy them low and sell them high, or try to at least. So let's take a look at how this looks. Price goes up, price goes down, price goes up, price goes down, and over time, it always goes back to the mean. Is that the correct pricing? Well, not necessarily, but it's at least what I'm looking for when we have to go there. In this example, I've taken up some of those that I invested in. And remember again, I only did this as a speculative play and only with a small percentage of my portfolio. I usually take around, it differs, but from $3,000 to $5,000. And usually I only do it twice. I can't really explain it, but somehow I've experienced, I've learned. Very often you could only do this twice. Third, fourth time, that's when we get into danger territory. But at least once and maybe twice. That's usually how it works. I've taken an example with a company called Hyliion. They were very, very hyped in the mid-2020. And I jumped in, and actually I liked the company at the time. It wasn't one that I was going to look for in the long run, but I was going to ride it a little and see what I could earn. And I got in pretty early, around, I think it was $15 a stock, I think. And when it quickly ran up to almost 27, I think I sold around 25, 20, 26, around that. In my mind, I was looking at 50%. A 50% gain is usually where it's safe. At least that's what I have experienced. And when it all of a sudden went down again, I kind of thought, this was one. I'm waiting for number two. And I think I bought back in around 20 again. And then it happened. It just got pumped and pumped. Everybody on YouTube promoted Hyliion. Hyliion was in all the videos. There was a lot of pump. So yeah, I rode the wave again. This time I held on. I held on longer than I usually do, because I usually say 50%. But this time I waited till we were almost 100%. I think I was a little bit over 100%. And I know I can't predict the market. I can't predict the price. So the timing can be off. I can be selling at not the top. I could be selling at, buying not at the lowest. But I try to hit the right place that fits me. And my sell target is usually at least 50%. And sometimes I let it ride for a little bit more. It depends on how much hype I see in the market. And this Hyliion stock, that was pretty good for me. I got 100% on the second hit and 50% on the first. I kind of knew that once, yes, twice, okay, but don't do a third time, and I didn't. And as you can see, the price just went down, down, down from there. And now we can take a look at another one. Nikola. Oh my God, don't get me started on that one. I kind of knew that I didn't know it was a scam, but I kind of knew that this was too good to be true. It was too polished. It was too nice to look at. And the products weren't really there. It was total Tesla copy. And I really didn't like Nikola founder. I don't remember his name right now. But anyhow, it got pumped by a lot of the YouTube channels. And when that happens, I start a position. And this time I bought in a little at almost, I think it was $12 a share. And then I kind of realized, oh boy, there's a lot of people promoting this stock. Maybe I should load up a little bit more. So I doubled my initial. I usually use 3,000 to 5,000, but this time I doubled. And I bought again. I think it was about 15. And now I had around 6,000 in this. And I just waited, and wow, it went up. It went up a lot. And it went up so fast that I actually at some point thought, I'm going to sell when it hits 30. But I didn't, because it just moved up so fast. So I kind of thought, okay, let's ride it. Let's see what happens. And of course, I didn't hit the top. The top was around $67, so I just let it ride. And when it was on the way down, I kind of thought, okay, 65, good place for me to sell. So I sold it all. This was one of those where I was supposed to take the second turn, but I really didn't want to, because I didn't feel it. I mean, the company was just, just didn't like it, you know? There's something where you just have a feeling that this is not right. And what do you know? All of a sudden, the Hindenburg research report came out, and everybody found out that Nikola was a scam. Oh boy. I was kind of happy that I didn't go in for the second kill. But look at the curve. You can see the curve. It's almost the same for every one of those companies. There's a couple of spikes up, and then it goes flat or goes down really hard. And that's a trademark of these hype stocks. Let's take a look at Tattooed Chef. Ooh, I know, this is danger territory, because a lot of people really like Tattooed Chef. But it was the same again. It was a company, was just getting started. Maybe had a great product, probably did. But what I saw was a lot of pump on the YouTube, and when that happens, I start a position. I always look at that. If everybody starts pumping it at the beginning, I'm going to jump in. And I ran in about, I think, 13, 14. And I was supposed to sell, usually again, 50%. I was supposed to sell, but this just went up and up and up and up. And I think when I hit around almost 100%, I thought, damn, I got to sell this. So I sold it again. And then I waited for the second, the bounce, the next hit. I went in again, this time around, I think it was 15. And then I just waited for my 15%. I waited for my 50% and sold it again. And I didn't get back in. I could have, but those two, one or two, that's all I do. I never do a third. I'm not sure if you know this one, Clover Health. It was a stock that it wasn't hyped that much on YouTube, but I saw it a lot of other places. I have a small investment group where we talk a lot about stocks, and a lot of people have new ideas. And all of a sudden this came up that there's something going on. It's being hyped, it's being pumped, and it was, I think it was around 10, and then it went to almost 13, and then quickly it came down again to 10, and I kind of knew, okay, let's go. Bought in around 10, and again 50%, I'm out again. And then I was waiting for the second one, and the second one came fairly long time after. I think it was 2-3 months later, but it came again at around 8. I bought in again, and I thought, I want at least my 50%. So I waited. Yeah, but it just went up, went down, and it didn't really realize. So I kind of got back and say, okay, I gotta sell this. So I sold it with a small gain, not a great gain, but just a small gain. This one I should have only hit once, but hey, I use the formula, 2 hits, that's what I take. Oh yeah, AMC, we all know that one, and we all know how that went. Again, the same formula. It's getting hyped on YouTube, it's getting Reddit, it was all over the place. I didn't get in on the early. I wasn't the early bird. I got in fairly late, I thought. Got in around, what was it? I think 18, 17, around there. And I was kind of going for my standard 50%. But all of a sudden, it just boomed. I mean, it rose like a crazy rocket in a few days. And I got kind of spooked and thought, nah, I'm going to take my 100% and then I'm going to jump ship. And what do you know? It could have been a whole lot more. And with the hype and all of the media attention, I didn't want to go in again. I just, once was enough. Palantir, yeah, I know. Maybe the company is great, maybe the product is great. They're probably going to be a great company in the long run. It's just one of those again. The hype, the hype, the hype. Everybody's talking about Palantir. Palantir this, Palantir that. When they do that, that's when I buy and I dump it as soon as I can again. I went in for the first one around 15, sold again my 50%, got out. I should have gone back in, but actually I didn't feel like it. I think there was again something that told me, no, don't do it. But hey, I could have gone in around 24, sold at 35, but that thing with timing the market and timing the lows and the highs, it's really difficult. Usually when I look at companies, I have a pretty good idea of where the bottom is. I have a pretty good idea where they can go. I kind of know what their intrinsic value is, and I kind of know where it should be. So that's why I feel I have an easier way of determining when to get in and when to get out. But remember again, this is only for the hype stocks. My regular core portfolio, I have done intensive work on all the companies, and I know exactly what they're worth, and I know exactly what my buy price is. And sell, well, actually my core holdings, I don't really sell. I kind of hold them like, yeah, for retirement, I think. Oh yeah, Rivian. I had a lot of people talking to me about Rivian. Oh, you should buy Rivian. When do we buy Rivian? Oh, Rivian. Oh, it's going to be the new. Oh, yeah. Are you kidding me? A company with this high valuation that hasn't delivered anything? I mean, the product could be great and it looks great. And they're probably going to be very, very great sometime. But not in the first couple of years. So, nope. I am only going to ride the hype train. I got in around the beginning of the IPO, just around 100 I got in. And I knew that this one was not 100%. I wasn't going for the 100%. So when I hit my around 50% mark, I sold it. And I thought about getting back in around when it went back to 100. But I kind of said to myself, no. This was a one hit only. I'm not going to take number 2 and definitely not number 3. I could have made a little bit of money, but no. I was convinced that people would see what it was and that it was way ahead of its price. So, nope, wouldn't go in a second time. Now we're going to take a look at some of my normal holdings, normal core holdings. And can you see the difference in the way that the stock moves compared to the hype stocks? Look at the curves. The curves are nice and smooth, and yes, they go up, they go down, but they don't have these huge bumps that the other ones have. These companies don't really get hyped the same way. These companies don't get pumped up and dumped like cheap something, you know. Looking at Google here, look at how smooth this curve is, even though it's actually not smooth, but it doesn't have these big highs and big lows that we see on all the other ones. The same here with Netflix. If we went a lot further in history with Netflix, you would see that Netflix had a huge run up, but it's still not a pump and dump. It's still not a high going up high and falling down. And just for fun, I put in Tesla too, because a lot of people, I mean, I don't want to call them haters, but a lot of people call Tesla a hype stock. And yes, I agree, Tesla is ahead of its valuation, but it's called priced in, that it's the market that prices in the future earnings, because Tesla is going to be an immense big company. And the earnings are going to blow the roof in the next couple of years. So yes, Tesla is high at the moment, but they're going to go a lot higher. And look at the curve again. It's not like the hype stocks where it just goes way up and way down. It goes up and it goes down, it goes up and it goes down, but it still follows a fairly smooth trend, just like the normal stocks. And here, if we look at them all compared, you can see the Hyliion with the big jumps, the Nikola with the big jumps, Tattoo Chef, Clover Health, AMC, Palantir, and then look at Google, Netflix, Apple. Fairly consistent, fairly straight. It's not straight, but a predictable course. That's what I would call it, predictable. So what is the conclusion about this? Well, trade the momentum. Yes, you can do this. Use the FOMO and the momentum to earn. I didn't take a lot of the other companies. There's a lot of other companies I could have shown here. I could have taken Fisker, Lucid. I actually think NIO is one of those two. There's a lot of these newcomers that are going to be hyped, bought, sold, and in a couple of years, they're going to be down where they started or maybe a lot lower. And then the typical investor would look at, when does the earnings come? I mean, that's actually what makes a company. A company that earns money is a company that has a good valuation. If the fundamentals are good, you will eventually win. That's what I always say. And I know, yes, I know, that was not what Benjamin Graham meant by this. What he meant was, don't buy the hype. When a company falls out of grace and goes below the line that you have set, below the intrinsic value, then you can buy it. And that's what he's going for. He's going for his margin of safety. I have a high risk profile, so I actually don't. I have no problem with putting money in those stocks at that levels, and especially not the hype ones. I mean, as long as I know fairly what I'm doing and I know how much I'm going in with, it's okay for me. I mean, $3,000, $5,000, it's around 1% of my portfolio. So I'm okay with that. I can afford to lose that if it would be. Then I'm going to use it in the end of year as a tax write-off. So I hope you got some value out of this video and maybe learned a little. And if you found some value in this video, I hope I could trouble you to hit the like button. And then I'll see you in the next video. Bye.
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the ninth inning, there ain't no point in resisting.